Welcome to Treasury Management and Hedging Strategies with our panelists, CEO and co-founder of Satoshi Action Fund, Dennis Porter, CEO and co-founder of Titan Mining, Ryan Condren, Director of Financial Risk at Foundry, Ryan Boyle, Managing Director at Trammell Venture Partners, Christopher Calicott, and Board of Directors of Iris Energy, Mike Alfred.
Excited to be here for this event. Thank you to the Texas Blockchain Council for putting it together. Always a great event, and a lot of people here. Wow, it's a fully attended room. Considering where we are in the marketplace, I consider this to be a strong signal among all the noise that's going on out there. We're going to be talking about what is normally probably one of the most boring topics in the space, but currently is one of the most important and exciting and consequential topics in the space, depending on how you look at it. We have companies that have performed well despite the bear market. They have made the proper decisions. And then we have companies who have not made the proper decisions and who have not performed well or void of any sort of strategy. Before we get into it, I'm going to go ahead and go down the line here. And by the way, a real quick intro from me. We're going to go do intros down the lines. Dennis Porter, CEO and co-founder of Satoshi Action Fund, which is a nonprofit. We do Bitcoin mining advocacy. So if you're a Bitcoin miner, make sure you come up to me and chat about how I can better advocate for the industry. If you're looking for the dinner that we're going to be doing later on the 18th, come hit me up. We have about 10 tickets left for that. Really interested in getting everyone together. There's going to be a lot of great people in the room for that dinner on the evening of the 18th. But let's go ahead and go down here and do intros. Ryan?
My name is Ryan Condren, CEO and co-founder of Titan Mining and co-founder of Lumerin Protocol. So we focus on private mining pools. We've built a highly optimized stack for private mining. And then we're also working on peer-to-peer delivery of hash rate for a decentralized, trustless hash rate marketplace.
I'm Ryan Boyle with Foundry Digital. I'm the head of financial risk. Foundry is the largest mining pool in the world, and we're also involved in kind of all other parts of the Bitcoin mining infrastructure value chain. So we have a marketplace for selling machines. We have participated in financing miners, and we are excited to be here.
Good morning, everybody. I'm Christopher Calicott, co-founder, managing director of Trammell Venture Partners. We're a venture capital firm based here in Austin, Texas, that's focused on backing founders that are building exclusively on the Bitcoin protocol stack. So not crypto, but Bitcoin focused, and happy to be here.
Good morning, Mike Alfred, private investor, board member at Iris Energy. Iris is a NASDAQ-listed industrial scale miner. Most of our operating facilities today are in British Columbia. We're very excited to be opening a new facility next year in Texas. Our whole thesis is that if you can use excess power, you can actually make the grid better and stronger. And so in a regulated market like Canada, we actually keep power prices lower for regular consumers. And in a deregulated market like Texas, we can actually soak up a lot of that excess power. So we're very excited to be here.
Well, I'm excited to be doing this panel and to be the first one out of the gate here, have the opportunity to chat about the absolute madness that is occurring in the space. Well, I thought the most exciting topic, to be honest, was going to be talking about Bitcoin miners and their balance sheet strategies, the difference in the strategies and how they've applied. But also we have now SBF and FTX with what is just literally having a void of any sort of strategy at all, like going the opposite direction of being responsible and looking towards the future. Let's do high level real quick. What's your brief takeaway? Start with Bitcoin mining. Let's stay focused on that. I'm sure somehow we'll gravitate towards talking about all of the madness that's going on outside of the Bitcoin mining space as well.
Did something happen last week? Yeah. Honestly, for miners, I mean, we have our power contracts. We're acquiring hardware, and we're mining blocks, and that hasn't changed. What we're seeing is disruption in the market. We're seeing people freak out. We see money changing hands very, very quickly. But at the end of the day, we're making sure our devices are still hashing, and we're still processing blocks. We're still processing transactions. And in 10, 20 years, we're going to remember, did the FTX bankruptcy really matter? It's like, how do you feel about cars that Studebaker went bankrupt in 1933? Who cares? It's a Bitcoin.
Yeah, I would just say, my perspective is that you're like the steward of your own coins. You're the steward of your own money at the end of the day. And, you need to make sure that as the steward of your own assets that you do the right level of due diligence to make sure that you're comfortable with the partners that you have. So unfortunately, the situation there is that, I think a lot of people didn't do the right level of due diligence with that exchange, and it's a very tough situation for everybody that's involved. And so, going forward, I think the lesson is just that people really need to dig in and understand who their partners are and find good partners, and continue to update that relationship on an ongoing basis, and continue to have good conversations and ask the right questions and dig in and get all the right financial information and have transparent partners at the end of the day.
I think I'm going to just share a little bit, little note about our background. We've been around Bitcoin since the beginning, really. And I can say, despite the noise, I think there's actually a lot of signal that's just right under the surface. And I'd like to point that because it's actually very hopeful. One thing that feels just very different, and we can have an academic discussion about whether or not there's actually cyclicality in these markets. But if you can get on board that maybe there is some influence in cyclicality, this feels different. Despite the chaos, which some people could predict, there are a lot of incentives that just drive bad behaviors. A lot of times they tend to be outside the United States, and we can dig into that later. Meanwhile, we're in a room absolutely filled with people. And I can tell you, in late 2018, kind of after the prior peak of Bitcoin all-time highs, any conference that you would attend, if they actually happened, it was because they were bought and paid for ahead of time. Someone was on the hook for it, and you would go in and there'd be sort of largely empty rooms, just sort of doom and gloom. And here we have hundreds of people that are actually very interested in what's happening. And meanwhile, all of those kind of what appear to be some sort of systemic risk, which we can talk about what some of those drivers are in a little bit, founders that are focused on Bitcoin are quietly but very feverishly working and building. There's just a lot of reasons to be very excited right now, specifically around the Bitcoin ecosystem and a much more sustainable, very long-term view and focus. So despite the craziness, I'm actually very happy and very excited for the future right now.
So I would echo the point about Bitcoin being very healthy, right, during this environment. So Bitcoin itself is sort of unaffected by all these shenanigans happening in these centralized, offshore, unregulated casino type companies, right, like FTX and others. And so, the Bitcoin mining space is a different story, though, because in the short term, hash price is at an all-time low. The global hash rate is at an all-time high. And so while that signals a tremendous amount of bullishness on Bitcoin in the long term, because who would want to turn on machines right now with the profitability where it is? But the reality is that in the long run, Bitcoin's going to be just fine. So that's why people are investing. It doesn't mean it's particularly fun to be a Bitcoin miner right now. But my view is once all of this debt and all these shenanigans sort of get wiped out of the system through the contagion effect after FTX, what we'll have is a very fertile ground for Bitcoin to come back even stronger in the next cycle. And so what happened at FTX? Like you basically had somebody who's essentially running this unregulated entity. They robbed customer funds to gamble with a related hedge fund. It's a failure of corporate governance, right? There was no outside directors on that board, right? We should pay attention to that in the future when we see that. It's a failure of having too much leverage, right? Because there's no regulation. People are levering up 10x, 20x, 30x still in crypto. We wouldn't see that in other places. And then you just have a bunch of people, kids essentially, gambling on sort of really unsophisticated arbitrage trades. People were piling into the Grayscale Bitcoin Trust last year. They got killed by that. They were piling into Terra Luna. These things have nothing to do with Bitcoin. So I think it's important to point out that while we have more work to do to clean up the sort of broader crypto ecosystem, Bitcoin itself is quite fine. And the best Bitcoin miners who survive till 2024, 25 are going to be wonderful companies and wonderful opportunities for investors.
A really great high level. I think one of the other things we should probably pay attention to is when people are like twitching on screen, like on camera, every interview they're giving, like smacking their lips.
Red flag.
Yeah, pretty big red flag now that we're looking back at that. Let's just dive into balance sheet specific balance sheet strategies. But before we get there, let's talk about why it matters and why it's so important. And also, what are some of the key metrics that people need to be paying attention to when they're observing their strategy? I'm gonna start with Mike, go right back to Mike, and then we'll hop back around and see who has something to add to this.
So our view at Iris has always been that we're an infrastructure company, right? So we don't think we add value by trading in and out of machines like a hedge fund or putting Bitcoin on the balance sheet sometimes and then selling it other times. I mean, there were literally companies that bought Bitcoin, miners, at 40,000, and then they dumped it in the market over one low liquidity weekend a few months ago at 17, 18K. Like that's not savvy investing. That's not savvy balance sheet management. So my view now is that if you're going to build high quality infrastructure, right? If you're going to build a really high quality miner where you actually own your own facilities, you own your own land, you build your own data centers, you have control over your operating environment, then it's okay to sell your Bitcoin every day for now while you build that out. Because otherwise you have to dilute the shareholders somehow through equity or debt over time. And of course the firms right now that are struggling the most took on debt that had full recourse against the parent company with full cross collateralization. And so we're seeing the results of that with some of these miners that look very distressed. And so I think it's okay. Like if you're going to build high quality infrastructure, sell your Bitcoin every day. When the market is better again in the future, you can raise equity and debt to add on to that. The other approach that works really well is like what HUD 8 has done. HUD's actually not sold any Bitcoin in years. They never took on too much debt. They didn't grow too quickly. They operated very conservatively. And now they have something like 8,700 Bitcoin on the balance sheet that's completely unencumbered. So that strategy works, but you have to be conservative. You can't get carried away in the bull part of the cycle and lever up, borrow too much money, try to build too many facilities too quickly. You'll end up hitting a wall and you'll end up having to sell that Bitcoin anyway. So to me, it's bifurcated. You either sell your Bitcoin every day or you hold all your Bitcoin and grow conservatively.
There's no like balance in between there. Maybe like when you hold in the bear and then like sell at the bull, like, you know,
I mean,
when you're profitable.
Again, as soon as you start doing that, your market timing,
Speculating.
you're just like the average speculator, retail speculator gambling on Dogecoin and GameStop. And yes, occasionally you'll get that right. You'll sell your convertible note at the peak of the market, right? And you'll buy back machines at the bottom of the market. But over time, I think that's value destructive for the average firm. These firms need to focus on building high quality infrastructure, not on trading the underlying assets.
You were whispering in my ear, that's speculating.
It's speculating. I mean, at the end of the day, you're building a business. You have fixed costs, you have OpEx you need to meet, and you need to go in with a strategy and you stick with your strategy. If you're going to mine and hold, then you mine and hold, but you make sure that you can cover your costs. You don't borrow to cover your costs. I mean, a lot of people forget that you're running a business. And sometimes the fastest way to become profitable in business is you cut costs. You know, I started mining in late 2012. My strategy was I'm going to hold as much Bitcoin as possible for as long as possible. But my power costs were pretty low, but I always made sure I set enough aside to cover power. When Bitcoin went from $1,200 a coin back down to $150 a coin, like everyone was wrecked. You know, this was terrible. You know, 2014, 2015. We're like, this is a terrible time. I shut off a lot of my pools. I shut off a lot of my miners. I started writing insurance software. It was a hard time in the industry, right? Looking back at it, do I wish I would have stuck with it and kept going? Yeah, I never lost faith. I never lost like the belief that this was going to be something huge one day, but I gave into the bear cycle and I didn't have a sustainable model through that. So we've learned these lessons, and now I think the people that survived the last two bear markets are like, oh, we're doing this again? All right. We already have the formula for this. Let's keep going.
Yeah, I think that's a really good important point for everyone that's listening here too, is like, try to figure out how to survive at all costs, because the people that survive in this market are going to be the ones that thrive in the bull market. I want to go to Christopher really quickly. Christopher, we talk a lot about the difference in balance sheet strategies. And one that I think that you can really nail down on is this idea of the difference between like a startup company, someone that's just getting going, and maybe like a publicly traded company. Like, how should a startup be viewing their balance sheet differently than one of these really large companies?
There's a uniform principle that Mike and Ryan both talked on. That's unsurprisingly, if you're building a company and you're looking for growth, you can't also be operating a structural trade around that. There's just too much that you have to control for when you're building an early stage company. And it's also a growth stage as a miner. Where things get a little bit different though in the startup world, typically startups in like my worldview is software startups. So not hardware focused, and we're looking for really great asymmetrical growth. My answer might be a little bit surprising. You know, investors, professional investors don't put investment into a company with the intention of that to simply purchase Bitcoin and sit on a balance sheet early on. And that's an answer for the startup ecosystem more broadly. that's meant to actually fuel the growth of the company itself. However, where this gets a little bit different is where my day-to-day is building Bitcoin companies. Bitcoin software startups, unsurprisingly, need Bitcoin to operate. If you're in the Lightning space, you have a certain amount of liquidity channel capacity you actually have to support. And so the difference there, it's maybe subtle, but it's not simply a balance sheet saving technology, which is what Bitcoin does best, but it's actually operational fuel for the growth of the company in the space you're building. So that's a little bit of a point of precision, but that's how I see it is differently. You know, we look for high growth early stage, and so when you have a more sustainable, clear cash flows where you can pay operations if you're in net profits, you can redirect some of that toward the balance sheet for long-term savings and improvement of the balance sheet overall, then that's great. But early stage software companies is not ideally a fit unless you're a Bitcoin company.
Going down the vein of like revenues and monitoring your balance sheet, like coming from the pool perspective from Foundry, Ryan, like how are you viewing how people should look at pools as it pertains to their revenues, and how do you view balance sheet strategies from your perspective?
Well, first of all, it's never fun when everyone agrees on a panel. So I do have a bit of a contrarian viewpoint here, right? So like I'm very much of the opinion that Bitcoin is a commodity. And so there's a long history, hundreds of years of commodity producers utilizing derivatives to hedge their assets. And so, I think that if you view Bitcoin as a commodity and this is the key, right? Like you have to hire quality people and you have to build real capability like large oil producers have over the course of history, that there are strategies that you can employ that can help you through these bear markets. So I would just say that. And then in terms of the pool, I mean, I think first and foremost, from a pool perspective, it's like at the end of the day, a pool it provides a risk management vehicle for miners. And so we're like I said before, we're sort of like the steward of the people who participate in our pool. We're the steward of their Bitcoin. And so, we're very, very particular. This is all relevant given the FTX stuff about making sure that we operate the pool independently of kind of everything else that we do. And then we have the right level of reserves available, given things like
So you aren't reinvesting customers' money?
I can unequivocally tell you that we aren't taking our customers, Bitcoin and reinvesting it to speculatively trade. So we pay it out, all of it every day, and then we keep some in reserve, and make sure that we bifurcate that very specifically. So
since we're on treasury management, we're talking about treasury management, I think picking your pool partner is probably one of the most important things a miner can do. Custodying funds and showing proof of reserve for a pool is incredibly important. But remember, as a miner, the pool is your source of revenue. And if you're sticking with one pool, then you have one source of revenue. And if you're going to scale to $1 billion mining company and you have one source of revenue with one pool partner, that's a serious engagement. Having backup pools, I mean, I'm a proponent of private pools. Like I'll sit on stage all day long and say, I think every at-scale miner should run their own pool. I mean, that's decentralization, right? More block producers. But at the end of the day, that's probably one of your biggest decisions is who's your pool partner going to be? Are they custodying your funds, or are you custodying themselves or yourself? What's their proof of reserve? Are they going to lock down withdrawals, or are they going to pay you out every 24 hours? Do they hold back funds, or do they pay you out? Do they pay everyone out every 24 hours? These are serious things our industry needs to solve, because at the end of the day, the most powerful entities right now in the Bitcoin space are probably the 3 top pools.
Well, we chatted a lot about what you can do and how you should manage and the strategies that you should follow. But let's talk a little bit about what you shouldn't do. And as it pertains to some of the companies, we'll say companies like Compute North or companies like Core Scientific. What were some of the things that happened? Like, people in this room want to know, why did those companies get into trouble so quickly as it compares to some of the others who seem to be surviving for now and doing okay? Obviously, things can change quickly in this market. But Mike, I know you are all over TV and all over Twitter Spaces talking about the various balance sheet strategies. And you don't need to specifically nail down on one company unless you want to. We would all love for you to kind of be specific. But what went wrong at companies like Compute North and companies like Core Scientific that caused them to fold under so quickly?
Yeah, look, I'm not going to discuss any of those companies in particular, but just generally, running a miner, an industrial scale miner, is actually a lot harder than it looks. It's not just a commoditized business. You know, you run machines in Texas and there's a lot of dust and there's a lot of heat, and you run machines up in the north and it's very cold, right? There are a lot of people experimenting with different operating models. It's not a well figured out science in my view yet. Like, people are still trying to figure out exactly how to get the most efficiency. And so people, you know, took on too much debt at the peak of the cycle when it looked like mining was always going to be really profitable. And of course, every cycle this happens, the hash price drops, and the people that you know, didn't understand the model, didn't realize how unprofitable it would be at the bottom, and didn't have enough runway, end up running out of steam. But I want to go back to Ryan's point real quick, because while I respect Ryan a lot, and Foundry's done an excellent job of de-risking their business and their lending book going into this, so kudos to them. They're going to be one of the big winners coming out of this. But even though I do agree that Bitcoin is technically a commodity, it's very different than natural gas, right? It's very different than corn. It's very different than gold even. You know, it's totally fungible. You can transfer it anywhere in the world. It's digital. It's built on like the internet rails. And so this idea that you need to hedge the same way a natural gas producer would doesn't really make sense to me, because I don't want to hold a lot of natural gas, because then I got to store it. And then I got to ship it somewhere to be used. And Bitcoin's completely location agnostic. It also has this beautiful monetary network on top of it. And so it sort of grows exponentially over time. So I do believe, while you can call it a commodity if you want, because the CFTC has some regulatory authority over it, I think it's sort of incorrect to compare it to other traditional commodities, because I just don't think it has the same characteristics.
Ryan, you were challenged. We have our first fight tonight. Ready to brawl? Where's the extra chair?
Yeah.
We need the security ready.
Yeah, that's right.
I mean, in a way, listen, it's you can make the case that it's almost a more efficient vehicle to use derivatives, right? Like like one of the problems with commodities, like you can't show up at the CME with, you know, 100,000 bushel of corn and be like, here, take my 100,000 bushel of corn and take it as margin against my position on exchange, right? Like, that's just not something you can really realistically do. Like, in theory, long term, with the right infrastructure in place, you know, you could do that with Bitcoin, and it actually de-risks the delivery in terms of those derivatives. So anyway, I mean, listen, I think I don't disagree with you. I think it's a totally unique thing that's very different than other commodities. You know, at the end of the day, I just think that, you know, if you have the right capability, you can come up with ways to potentially help you get through these financially tough situations. So,
Ryan, what are some ways that we can de-risk? What are some products? Are there things, any specific ways that we can use
how much time
systems?
Look, okay, so let's start with commodities. We have coal as a commodity. We turn coal into power. Power is a commodity. We turn power into hash rate. Hash rate's a commodity, right? You want to de-risk, you can sell off at any point in that trade, but where I'm focused with one of the protocols that we're working on is literally selling hash rate, peer-to-peer trustless globally. We have these little toasters, these magic machines that they don't just burn electricity to get coins. We're literally translating electricity into hash rate. Now, what's great is power is confined to a grid. It's very local. We could call it analog. You translate that into hash rate. Now you have something digital. That's something that is global. You can actually transmit your hash rate from here to Europe, from here to Asia. It doesn't matter. It's a global commodity. You can do that anonymously, trustlessly. And that's actually something that I'm working on. Is I want to see a global peer-to-peer hash rate exchange, where if you want to de-risk and you want to forward sell your hash rate, you can do that through a smart contract. You can do that through a decentralized engagement, where someone else can post the payment, and as the hash rate flows, you collect payment, and we can do all that anonymously. So it's up to you how much hash rate you want to sell off, and that's one of the visions I have. Is eventually I would love to see pools literally bidding against each other to buy hash rate on an open market, rather than pre-signed for years.
This is actually an area that I think people should be talking and thinking about a little bit more. There's Mike earlier mentioned there's essentially historically two ways you can grow. You can sell equity, super dilutive to the founders the operators of the company, or you can take on debt. But these forward hash rate contracts, this is a kind of derivative. I think that's like a third pillar on the ability to actually grow over a time base. Maybe it's, we want to improve our capital position in terms of ASICs over 90 days, but I don't want to give up a long-term piece of the company with equity or what the ramifications of debt are in a drawdown environment. So a finite contract for some specific period of forward hash rate looks like an area that institutions should get very interested to participate and trade in. And one of the pieces that we've done an investment in fairly recently that kind of intersects this is to be able to settle payment for large power purchase agreements through a SAT stream in real time from the consumer, the miner, and the producer. So all of the additional transactional costs and the risks on for the energy producer are kind of mitigated in that regard. I suspect that's something that's going to open up in the next 2 to 4 years. I mean, there have been a few attempts. They haven't really reached institutional achievement. That's kind of a middle ground that maybe you were looking for on scaling out mining operation. But on the other hand, I think fully hedged, while yes, you can legally think of Bitcoin as a commodity, I mean, what the hell are we doing here? If I'm going into the mining business in some way, it's because I want to have more Bitcoin in the future than I have today. And while I might be able to manage the operation of the business, I think it would be just sad to have been there for 10 years, very securing the network, producing Bitcoin, selling it, at the end of that, have less than you started with. So I think that's, for me, it's a question of like, what are we actually trying to achieve as a business? And so anyway, that's my 2 sats.
Yeah, no, I mean, first of all, that product you're talking about, Sonoda, which I'm very excited about, so I'm really glad that you guys are getting involved with them. The potential of it is going to really help to unlock Bitcoin and Bitcoin mining. I mean, you're right. It's like when you get into the space, even if you jump in just because you're excited about Bitcoin mining and the potential to have a business, you quickly become somewhat of a, some people would say a Bitcoin maximalist, but at the end of the day, you want to hold as much of this Bitcoin as possible. But is there any sort of conflict there? And I'll go to Mike and then Christopher, anybody else wants to jump in on this. Is there a conflict? Like, should Bitcoin miners be viewing themselves as a business, or should they be viewing themselves as holders of Bitcoin? Should they be irresponsibly long on Bitcoin, or should they be trying to reinvest in their infrastructure?
Yeah, and it's a super complicated question and formula, right? Because the question is, are you still alive in 4 years or 8 years? And just historically, a lot of the miners don't survive these cycles. And so obviously the math for the people invested in those companies, they would have been far better off just buying Bitcoin. And this is the argument I hear all the time on Twitter Spaces. The maxis will yell at you for doing anything but holding Bitcoin in cold storage. But can you imagine a world where the only thing we did with Bitcoin is all of us all held all of our Bitcoin in cold storage and never built another business, right? And we required all healthcare companies to put their entire balance sheet into Bitcoin, so there's no new cancer drugs. And we required all energy companies to stop developing natural gas, right? And so I think there's a balance there, right? There's got to be some equity-like return coming from the businesses that are adjacent to Bitcoin. Otherwise, you just have a really cool monetary network that everybody owns Bitcoin, but nobody uses it for anything. And so there's a conflict there. I don't know what the answer is. During the down cycle, it seems very obvious you should have just held Bitcoin, right? Because if you invested any money in Bitcoin mining anywhere in the world, public, private, whatever, over the last 12 months, you're down quite substantially, and you're down relative to the price of Bitcoin. But over a 5 or 10 year period, if you build a world-class miner, it's possible you outrun the return in Bitcoin. And that's where, back to the point on that Ryan made, Foundry, like hedging makes sense, I think, with natural gas. I'm not sure it makes a lot of sense in mining, because if you don't believe that Bitcoin has value in 10 years, you shouldn't be mining today, essentially, right? Like, you shouldn't mine at all. You shouldn't even be in this business if you don't believe in mining Bitcoin.
Let's go down the line real quick. Christopher, hold the Bitcoin or sell the Bitcoin?
Look, I mean, you're asking a guy that I'm still trying to get as much Bitcoin as I can. The last few weeks,
save some for the rest of us.
Moving dollars around, just So I mean, yes, the answer is obviously yes for me. The trick, though, is scaling a business, and mining is by design meant to be hyper competitive. And so, how do you thrive and maintain a net growth position in the market versus your peers unless you take some risks? And so, it's important to acknowledge that the incentive there tends to make miners take outsized risks. And so I think having some prudence in the approach, and it's important, but I mean, I can't imagine being a miner without a core goal of just trying to have more Bitcoin than you started as just the first principle.
Ryan Boyle?
Yeah, I mean, I agree with Mike at the end of the day that, it's a very dynamic situation, and it's just very easy to say we should all hold our Bitcoin. But at the end of the day, you're running a business, and so you have operating expenses, and you've got to walk a fine line between continuing to operate your business and I agree with Chris, like trying to get as much Bitcoin as you can if you believe in kind of the long-term thesis. So I don't know. I know that's a very kind of in the middle position, but
How dare you be rational and
Yeah.
in the middle on any position? That's not allowed these days. Condren?
I've been running profitability calcs for years, trying to figure out if it's better to mine or buy. And it's so many variables that go into that. I was devastated when I bought Bitcoin at $900 back in, 2013 or something. And then it dropped. And I was like, oh man, what did I do? Like, what did I do? I should have just bought miners and I at least had the hardware. That's the reality of it is, when you're building mines and you're building the hardware, and if the hardware is still serviceable, I ran S3s for a really long time. I ran S9s. S9s were profitable for a really, really long time, right? With the market adjustments. You'll always have that hardware. You always have that hash rate. You're essentially setting yourself up to be a type of utility where you're producing hash rate. Do you hold the Bitcoin or do you sell the Bitcoin? That's all up to your strategy, right? Your risk assessment. And, it's funny, I heard a podcast with Michael Saylor, and he was talking about FTX, saying that there were no adults in the room, and there was no one helping build the treasury management strategy. That's, when you're building a business and you're scaling your mine, that's something that's going to be seriously foundational, is what's your strategy, and you stick to the strategy. If you're going to mine and sell half to cover your OPEX, given that your OPEX stays stable with your power contracts, and the price of Bitcoin willing, then you stick to it. But I know a lot of people that have mined for years, and their strategy is you hold all the Bitcoin you can, you borrow from friends and family, you put stuff on credit cards, you do everything you can to hold the Bitcoin. When they started early, that worked out great for them. If you started in 2018, 2019, it worked out for a little bit. We had the giant hash rate migration. Now it's, as I said, it's a complicated question, and it's up to each individual to decide what their risk profile is.
If I could take off my Iris Energy board member hat for just a second and just make a comment from the investor standpoint, though. I think one of the best analogies for this Bitcoin mining ecosystem right now is the internet data center business in 2002. So if you look back, there's these large internet data center REITs like Equinix, the ticker is EQIX, that traded briefly in 2002 at like $3, $4. Later, at one point over the last year or two, that stock hit $800, $900. And that was just a fundamental bet on the future of the internet. It was just, do you think the internet's going to be bigger or smaller in 10 or 20 years? And it turns out a lot of people at that time got that wrong because they were watching the securities prices. So they're watching the screen and they saw all these stocks going to zero. And it is true, like 95, 99% of these stocks that were touted in 99, 2000, I was trading those stocks in my Stanford dorm room at the time. And they all went to zero, like a big chunk of them. Amazon obviously didn't, right? Yahoo obviously didn't, but a big chunk of them did. But if you believed the media that the internet was never going to be a thing and Walmart would never have to have Walmart.com, then you basically missed a huge economic opportunity. These sort of the same exact thing is happening now with people saying Bitcoin is dead because FTX went down, or because Celsius went down, or BlockFi went down, or whatever. That's completely irrelevant. These are centralized companies that have nothing to do with Bitcoin. Zero Bitcoin on the balance sheet, right? And so if you use that analogy, I would argue from an investor standpoint that we're getting near a generational opportunity to buy both Bitcoin and top class miners. If you can pick the ones that don't go under, there's a handful of 20, 50, 100 X's in that pool over the next 10, 15 years. And again, you got to hold your nose and buy it at a rough time, but I think it's a real opportunity.
I think we would be remiss not to talk about one important thing. Whatever your decision would be in terms of managing your balance sheet, the amount of Bitcoin spot exposure you have directly, one thing that I've been pounding the table for like at least 5 or 6 years is, if you look at Celsius, if you look at Three Arrows, if you look at obviously FTX. If you look at all this, there is one common thread that goes throughout that. And it's if you're scaling a business and you need credit, what's happening to your Bitcoin in that process? Most of the time, we've taken, people that come from very smart people from Wall Street, they're used to this idea of rehypothecation, where they take your assets, they use it for forward credit, and who knows what it's being used for. Understanding your counterparty is existential, because if you have a view that Bitcoin will be bigger and stronger and broader of adoption in 10 years, you want to make sure that in 10 years you actually still have Bitcoin. And right now, those risks, the commonalities are really fundamentally what's happening. We've made some bets over the years that you need to be able to have line of sight of exactly where your Bitcoin is long-term in your trading partner. And as long as you're able to cover the debt service, it's just very key. It's very fundamental. If someone loses your dollars, well, they can print more dollars. If your Bitcoin is lost, it's fully gone. No one is going to be there to make you whole. And so trying to put this pattern match onto Bitcoin is a fundamental logical error.
Real quick, just we're halfway through closing comments now, and I'll have you two, both the two Ryans will close us out. We got about a minute left, but I'm sure you can get a couple more seconds on top there.
I was just gonna say, if I was gonna draw a line through Celsius and FTX and Mt. Gox or anything else that went bad through the last decade, it'd be trust. We're trusting institutions. And if you look at the way Bitcoin was developed, its beauty and simplicity, it's trustless. What's awesome about mining is I can generate Bitcoin anywhere in the world anonymously, trustlessly, and no one has to KYC AML me. No one has to know who I am. I can generate Bitcoin with hash rate. So hash rate is the trustless global commodity. That's why we're, at Titan, we're sending out private mining pools. That's, it's trustless. That's why we're working on the Lumerin protocol. It's trustless distribution of hash rate. Where should we be at in a decentralized ecosystem? We should stay as trustless as possible. That way, you don't find yourself in these situations.
Yeah, I don't have a lot to add. It's full circle to my first comment, which is at the end of the day, like you're the steward of your own assets, and so you have to do everything you can, to make sure that you protect them. So
Awesome. Ryan, Christopher, Mike, thank you so much. Appreciate it. Thank you everybody for watching, listening in.
Thanks, guys.
I'm Lee Bratcher, the president of the Texas Blockchain Council. Thank you to everyone who came out to this year's summit, helping us make it the best one yet. Now more than ever, we need professional industry associations like the TBC to help craft effective policy instead of the CEOs of centralized exchanges roaming the halls of various state capitals or in DC. Texas is quickly becoming the center of the universe for Bitcoin, blockchain, and digital assets. If you want to be part of the future that we are crafting here in Texas, join the TBC today.